This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Buongiorno a tutti. I am Paolo Sironi, and I'm your host for the Banker's Bookshelf podcast. The Banker's Bookshelf is our collective moment of critical reasoning inspired by authors and researchers of the most interesting books, papers, and publications which are finding their space in the libraries of curious bankers and fintech entrepreneurs. In each episode, I invite authors and researchers to share views that challenge the status quo and common assumptions in financial services. They challenge business culture and technology expectations to help us understand the banking present and its fintech future. With that, we can all make better informed business decisions. Therefore, it is a pleasure to open our third episode of the Banker's Bookshelf with an anthropological perspective of the need and value of financial services. I have with me the two esteemed authors of Customer-Centric Innovation in Finance, leveraging human insights to drive product innovation in the digital age. And it is a very interesting book that has just been published, and you can already order it on Amazon. So let me introduce you to them. They are the economist Anette Broløs and the anthropologist Erin Taylor. Anette and Erin, welcome to the Banker's Bookshelf.
Thank you so much, Paolo. Great to be here.
So who are they? Erin Taylor is managing director and co-founder of Finthropology and an anthropologist based in the Netherlands. She specializes in how people's financial behavior is changing along with innovation in financial services. She holds a PhD and has carried out ethnographic research in the Caribbean, South America, Africa, and Europe. Erin, quick question. What does it mean to be an anthropologist in finance?
Actually, it means quite a lot. I think people don't realize how much of a long history we have of doing financial style research. There's a long history of anthropologists going to all sorts of faraway societies and studying their economic systems and how they make money out of shells and so on and so forth. This is just the contemporary manifestation of that long history.
That's very good. And then Anette Broløs is the director and co-founder of Finthropology and a fintech analyst based in Denmark. She's an experienced fintech and financial services leader working on strategic innovation, partnerships, open banking, and digital transformation, and an experienced speaker and facilitator. She also holds an industrial PhD in collaborative innovation and has a background in economics. Anette, your background in economics interests me. I believe we need a reformed economist to move the needle. So are you a reformed economist or a traditional one?
I think I'm an informed economist. I did my training a very long time ago, and it was really when I did my industrial PhD that I realized how important the people perspective is in finance and how poor many financial organizations really are at considering people when they work with their innovations. And I have actually myself in the capability of building innovation strategy in the company, received the comment from a consultant that why are financial services always working inside out instead of outside in? So yes, a reformed economist, you can call me that.
That's actually very good. And I like that today we are really discussing about content of a book, which is based on research and a different type of research that has a lot of qualitative aspects and elements, which are very important and often technologists and economists forget to look at. Now, let me tell you why I found Customer-Centric Innovation in Finance a very interesting read for all of us who work with technology in financial services. A few considerations. I believe that one of the common mistakes that fintech entrepreneurs make, and sometimes bankers as well, is to believe they can export experiences built for other industries like e-commerce, when people buy things, into financial services, without realizing that anthropologically, the way we deal with financial services is different from the way we deal with other elements of consumptions, like buying a book or buying a purse. The key essence of this discussion is that mobile, which is the technology that we use for digital finance, so your iPhone or your Samsung phone, is a technology of the demand. What does it mean? It means that you don't go on Amazon to see what happens. You go there because you want to buy this book from Anette and Erin, and maybe Jeff Bezos wants to sell you also another one that complements your interest. But when it comes to financial services, typically people need to enter a conversation, a relationship, because they need to go through emotions, which makes this financial services industry, for the most important revenues, an offer-oriented industry. So the question is, how do we put an offer-oriented industry onto demand-driven technology? And that's why I believe that the anthropological perspective is very important. So then, I remember I was making a presentation of my fourth book, The Financial Market Transparency, to the Arab Sab conference in Dublin some years ago. There is a conference when behavioral scientists and economic psychologists gather to discuss key themes around behavior and financial services. And while I was presenting, I said something that made some people falter. And I remember a lady from the Max Planck Institute for Human Development raised her hand. They said, "Can you better explain? Because that's really interesting." I just said that money is emotion. Now, we tend to believe that money is a mathematical thing because we have mathematical formula models. I was a quantitative risk manager in the 1990s. In reality, since the future is open and nobody knows the future of financial services, emotions are important because when uncertainty is so relevant, emotion helps to complete rationality because we need to accept that we don't know the future, no matter how many and how much data we possess. So then by understanding where emotion, which is not an emotional element, comes from anthropologically, I do believe that we can better shape financial services in terms of new business models, the language used, the technology which is deployed, so that we have a better fit between banking, technology, and people. So then, Anette, as I started reading your book, I immediately got drawn into the reading that you are actually saying that money is emotion. So I found myself so much into it. Now, what is your definition of emotion in money management or financial services?
Well, I think that what we look at is particularly that money is very emotional. And as you are probably well aware, and as you also mentioned, we are used to discussing money in logical terms as people in finance. But when we talk to people not necessarily in finance, as consumers, as users of financial services, there is no doubt that money is emotional. We have all read the stories about how people hang on to new crisp bills a lot longer than old crumpled ones. We all know the stories about how, and maybe we have experienced it ourselves, about dreading expenses and messages from the bank, not daring to open them because they might be frightening. So money is definitely emotional. And also, I think another important perspective is that money is very much social. So it's part of our everyday lives. A Danish researcher, Kirsten Bonde Sørensen, did a very interesting study where she interviewed people in a regional bank. She asked them to draw their relationship with money. Mm-hmm. And to talk about it. And what she saw was that they were drawing relations back to their childhoods. Some had never discussed childhoods throughout their childhood and were worried when they grew up because they couldn't manage money. They didn't know anything about it and felt emotionally stuck in some place. Others experienced lack of money in their childhood and remembered it as a dominating issue, causing arguments and fright in families. So it is very important, and it has long threads into future perspectives as well. So, and also, as Erin mentioned before, there's no doubt that money is social in the sense that that we build community solutions. We rely on each other. Maybe sometimes it's nicer to ask a friend or a family member for a loan than to go to the bank and explain why you need it, or maybe why really you don't need it. So there's no doubt that money is emotional at several levels.
Okay, so let me sum it up and maybe add a bit more from my thinking. So money is born in human society to foster our survival, essentially. It's just that we might have forgotten that, but epigenetically, that is why it hits emotions, as money is needed for survival of humans and is part of society in the management of society. Now, in my financial market transparency theory and principles, I discussed the gap between Homo sapiens, that is the first one dealing with money, and Homo economicus, which is an idealization on how the Homo sapiens behaves facing a financial problem. And what we have all experienced is that this gap has been very concerning for financial services. When Alan Greenspan, the former Fed chairman, was invited to explain to the Senate committee in the US why the financial system was collapsing in 2009 after the default of Lehman Brothers, he said, "I found a flaw in the model." And I said, "What did you find?" And he said, "What is a model? It's a conceptual realization of reality. And I found a flaw in the financial services model because we believe that people, institutions are rational. They're not. And market are efficient. They can be." And he said, "Don't ever the fact that it seemed to work, this idea, for 50 years, it's not working anymore. I don't know what to do with it." Now, to resolve it, we really need to go back to the understanding of how Homo sapiens differs from Homo economicus. And that means making real life observations of real people behavior. That is essential. And this is something that we can find in this new book. And Erin, as an anthropologist, maybe you can explain to us why real life observations of real people behavior are somehow forgotten, typically, but they're so essential.
Absolutely. Thank you so much. That's a really great question. So, of course, we all know these days that people's behaviours are complex and we don't always behave in rational ways. And in fact, we certainly don't act as individuals most of the time. We act as social beings. And so if you want to find out what people are really doing, you need to look at them very closely. It's often said that quantitative data will tell you what people are doing, but qualitative data is better at telling you the how and why of what people are doing. And so you can use techniques like interviews and also in-person observations at a deeper level to find out what people are actually doing rather than what they just say they do, for example. So anthropology has been doing this for a very long time. Over the past more than 100 years, anthropologists have gone to different field sites and spent a lot of time in location participating in daily life and watching what people actually do. In this day and age and in our kind of field, it's difficult to go to somewhere for a year or two, but you can still emulate those techniques in a short period of time. So, for example, in the research we did on payments and the possibility of CBDCs in Brazil, we went to Brazil, we went to 2 sites, we did a lot of interviews, and we also spent time on the street watching people's behaviour. And if you do that, you can pick up some very interesting things. So when it comes to payments, people in Brazil are very much guided in their choices by their feelings of safety and their feelings of trust. We found that most people, including very low-income people, had multiple bank accounts, they had credit cards, they used payments platforms, they used cash, and they had to choose between these things. So how do they choose? So we stood on street corners and watched people and their behaviour in different places, different marketplaces, different socioeconomic areas to see how their feelings of safety affected their behaviour. Were they happy waving cash around, using their phone in public, or were they more guarded? And so what we learned is that in different places, people will have different behaviours and make different choices. And so that's a really big advantage of actually taking the time to watch people rather than simply go on face value or try to glean this information from quantitative data. If you're looking at people using multiple payments tools, that information isn't going to be in any data set anyway.
Very interesting. So I once had a public discussion with Richard Taylor on Twitter, as we were saying that the debate rationality and irrationality is somewhat misplaced. It's not that not being rational is wrong per se, because the rationality is true only ex post. Ex ante, you don't know all the data that are needed to understand what is the good behavior that you need to have. But in particular, there were other reasons from the mathematical perfection that indicate why people need to make certain decisions. And also these reasons can be relevant and need to be understood. And therefore, these real-life observations are super important because they might unveil elements that cannot be otherwise and could never be, if you like, measured or collected through a quantitative method. Now, Anette, you can maybe give us some examples on how to use real-life observations to understand how people make decisions. I believe that you have some in chapter 4 of your book.
I think we have we tried to distill the information from several studies, including our own, and in that chapter to describe what's actually driving people's decision when it comes down to it. And I can certainly run through some of the examples. We know that value is important when people have to make monetary decisions. And some of what we can see is that people consider value very much in the terms of what we would now call embedded finance, in the sense that do not only, because who considers that, consider whether a fee for a payment is expensive or not, but whether the payment tool like a credit card comes with loyalty schemes and discounts when on your shopping. So they're quite adept usually in different countries on choosing what's the cheapest solution.
So let's say that value is a multifaceted element that cannot be distilled only looking at one specific element of the intermediation with a client. So it's a bit broader, more 360. And if you don't understand value, you can digitalize value.
Certainly, it's much broader than that. And also we know that convenience is an important driver. To give a simple example, we could certainly say that look at the use of NFC in payments, the fact that we can use our phone and just tap and go and not be interrupted in our social conversation with people when boarding a train or buying a cinema ticket or whatever. So the convenience is a driver. We also saw in our study of Swiss women, where we interviewed people about their payment behavior and asked them to share all what they had in their bags and how they used it, and we saw that they would prefer to use only their phones because they didn't need to carry a bag. So that's a good example.
It's very interesting. Now, you mentioned embedded finance. In my latest IBM research on embedded finance, we investigated how people prefer to access financial services. There is clearly a difference between the various services like payments and credit, which are a bit more symmetrical information, like you get the money or you have the convenience, tends to be a bit more, if you like, end-to-end on digital, while investments and insurance might start on digital or end on digital, but require some conversations with people. So the relationship is still important. For example, thinking about investments, it seems that people make decisions with people. Then yes, they would like to execute on digital and control it, but the way they forge their decision-making process tends to be more relationship-based, looking at what other people do, what other people think. It gets into the society and their connections around them. So that allows me to connect the two concepts, like working in context with embedded finance and understanding anthropologically how people make their financial decisions, which basically opens up a question for Erin. That's very anthropology for me is very, very interesting. You might not know that our former head of big data at scale in IBM was an anthropologist herself, and I say hi here. So I always wonder now, how do you innovate in financial services with an anthropologist mindset? Can you help us understand that?
Of course, I'd be glad to. It does require a bit of a shift in thinking. Particularly, it requires a shift of thinking away from individuals and specific use cases to thinking more broadly about groups of people, multiple use cases, etc. So it's about thinking more holistically, we could say. So some examples I could give about thinking holistically would be, for example, the one I mentioned before about Brazilians using many different types of payments and many contexts affecting how they make those decisions would be a great one. Another one is how people cooperate with family members and perhaps friends and more distant relatives as well. I think we often forget how many of people's financial decisions are actually social and not personal. So we all have this, when we make our financial decisions, we're not just thinking about ourselves and what we want. If we have families, we're thinking often about our entire family, or we might be thinking about our sister, whose birthday's coming up. We really need to keep this in mind because other people's preferences, needs, etc., influence very much what we do. Another really great example is this thing that's called workarounds. So often people will encounter problems when they try to make a financial transaction for one reason or another, and they have to find creative ways to combine different financial services or change the way they're doing things in order to achieve what they want. And a really great example of this is when we were doing our study of buy now, pay later services in the USA, we found women looking to use different BNPL services for different purposes. And one of the things people wanted to do was to be able to buy gift cards, but not all BNPL services let you do that. So they were trying to find different ways. So to sum up, the anthropologist's mindset involves stepping back from specific questions and looking more broadly and being willing to discover new things you hadn't thought about in the first place.
So a few words I picked from your answer, which really resonate with me. You talked about groups, you talked about families. So for example, talking to bankers in my role, I often tell them that the economic unit of digital finance is not the individual when we talk about personalization, but it's a family. However, we define family like a closer relationships because it is the liability of people that allow personalization, the children, our education, what we want to do, our relationship on how we deal with everything in our life. And that is the first element. But we tend to see the individual like an isolated human being that somehow is free from any connection with the world, and then we start from that. There is also an interesting case study about Haiti inside the book. I think it's chapter 5. Can you just say something about that?
Yeah, absolutely. That's actually a really great example of using this kind of mindset to innovate. So thank you for reminding me. So we did this 3-year-long study of mobile money in Haiti. In fact, we began the research before mobile money was launched. We went back just after launch, and then we went back a year after that to see the changes that had occurred once it was rolled out. It was a fascinating study looking at trying to think about how people, what their needs were for sending money, what the possibilities were in terms of the infrastructure. One very interesting thing we found very early after launch was that people were using mobile money a lot to send money to themselves rather than to family and friends. And they were doing this because of safety concerns. So they might get paid one day, deposit their money, travel across town and pick it up again. And we named these me-to-me transactions because they're sending it to themselves. So that was an important finding, and we made this known to Digicel. And sometime after that, we don't know whether it was our influence for sure or not, but they made an advertisement featuring this elderly woman hiding money around her house and then deciding instead to deposit in mobile money accounts for safety. So that's one example of how insights may lead to a change in, let's say, marketing, for example. But ultimately, though, what we discovered in that research is that most of the problems with mobile money existed in the agent network. It wasn't extensive enough, and the agents weren't behaving the way they should be. They were giving their agent account to their friends to use. They were not there when they were supposed to be. And so people were struggling to use this network. And as a result of this, actually, Digicel had to completely relaunch mobile money to fix those agent problems as well as the marketing of mobile money.
Understood. Now, what we are learning here is that the anthropological perspective is foundational and should precede the design of innovation to make the right first step. If we don't make the right first step, we will incur into higher innovation cost or lesser product success because then things have to be rewired and redeployed. So, Anette, can you provide us with examples that you also share in your book about institutions overlooking these aspects and therefore incurring into higher costs or the need of readjusting what they just created?
I think what we saw mostly in many of our studies, and I'd like to share a few examples in this space, is that when you work digitally, you're so focused on the fact that you actually have a lot of information about your customer and putting it to digital use because it's fast and efficient. But it has stumble stones in it. We all know that if you send out a survey and ask people what they do, they may tend to answer what they think they should do, consider safety, rather than what they actually do, consider convenience. And also, like Erin mentioned about our Buy Now, Pay Later study in the US, we found that women are not as expected using only the one and staying very loyal to a specific merchant. Rather, they are using 3 or 4 different Buy Now, Pay Later solutions to fulfill their needs because they know very well what they need and they'll go and do that. So considering that, if you're not considering that, you may actually put out an innovation that costs you money and doesn't get the uptake that you want. Another perspective is the fact that you may be overlooking completely specific customer groups. And we could talk about the young, we could talk about small and medium-sized enterprises, which I think is quite well known now. But we've mentioned women as well, because women generally feel condescended to when they go to talk to their bank advisor, both as consumers, as CFOs in big companies, and as entrepreneurs. So they generally don't feel that they feel that they're considered stupid and somebody is trying to pin down easy things for them and not answering the more important questions that they actually have. And if you look at the new report out from the International Finance Corporation, you can see that even in fintechs, only 25% of customers are actually women. So this is a great area to expand on. And then I think we may come back to this later, but there's a general tendency to perhaps underestimate customers and think of them to somebody who should learn to adopt solutions from the technologically advanced financial institutions. But generally, people are quite well aware of what they need and what they can do. So they may not be able to calculate interest rates or understand yearly costs, but they do well understand the risks that they're carrying and the issues that follow from that. So I think that there are many perspectives that you cannot catch when you look at digital data and quantitative data, where you actually need to talk to people and to see them in a context.
So we said a couple of things in the last 2 pieces of conversation. We said that there is an incentive problem on how the agents behave that needs to be learned and considered. And we said that it's not just mathematics, expected returns. It is also about the context, which means the 360 perspective around people. Now, let's start from the first and give you my example. Typically, the financial services industry makes money by getting paid through embedded commissions or fees. That means if you are invested $100, there is a percentage of the AUM that rewards the work of wealth managers and money managers. Although it is important to learn how to invest, that doesn't mean that we need to invest 100% of our wealth, because part of it is needed for where we need it for survival. It needs to go somewhere else as a liquidity element. However, that cannot be remunerated in the industry. So there may be a tendency of asking to invest too much instead of being more sober into building our portfolio to become anti-fragile, if you like, more than just invested economically on the future frontier, which means everything needs to be invested to increase the return. And on the other side, it's only when we put this decision-making inside the context of our life, of our goals, that we understand the fact that some investments are needed with a certain level of risk. Other elements need to be positioned with lower risk or more liquidity, so less return. But the combination of both is relevant. And that means planning. Planning is a context. Now, I just read a recent analysis by JP Morgan confirming that more than 50% of their intermediation process with clients now goes through the planning process. Because having planning at the forefront enables to, if you like, help people better understand their needs and so position the decision-making in the context of their life. But that means that understanding clients is not so straightforward, like connecting some data. It needs to be broader in that definition. And I guess technology can also be leveraged to connect all the dots from the micro then to the macro level, because we want to look at individuals and that society. And we know that you just mentioned women, for example. In many cases, there is a financial inclusion problem that also needs to be addressed, helping people that have been left out somehow in the decision-making process or in the credit process to participate into the economy, to get supported by financial services to move forward in life. So now, Erin, this is always a big problem, reconnecting the micro with the macro elements. So how do you believe that understanding the individual in the context of how that individual interacts through life with society enables to connect the dots to address also financial inclusion that is such a relevant topic in all societies, including the major advanced economies?
It's a really good question, and especially because it's changed a lot in recent times. The whole financial inclusion space has dramatically changed with the advent of digital financial services. So in the early days, digital financial services were seen as important to increase financial inclusion in the global south, but that sort of stayed there. These days, actually, we're seeing a lot more services develop in what you might call the global north. And so there's less and less difference between how technology is being used for financial inclusion across the world. We have services for women, as mentioned. We have services specifically for refugees, for example. There are services for the elderly and so on and so forth. So technology is really a way to develop appropriate products for more people. And that goes beyond financial inclusion, because these days, most people are financially included somehow. It's the quality of the financial inclusion we're worried about. Technology can play a great role there in increasing the quality of the products people are using and the quality of the services. There's just one caveat I would like to make, and this relates to a myth we discussed in our book regarding financial inclusion. And the myth is that technology works. The problem is that these days technology doesn't still work everywhere in all times and places for all people, especially still in the global south. Sometimes also in the global north, we see problems like software glitches, login issues, all kinds of things getting in the way of transactions. It might be that ATMs are locked behind a door physically and you can't access them outside of opening hours. So if we want technology to serve the needs of people better, we need to make sure that the technology actually works and it's accessible for everybody as well.
Yes, one of the key features, for example, of the digital euro is the fact that digital money needs to work offline as well, because we're not always online and that cannot be always provided. So this online and offline balance is super important, because otherwise we might exclude more people than those that we wanted to include at some point. Now, Anette, you certainly investigated in your research and in this book some good and bad examples that allow to understand how the qualitative and the anthropologic-oriented research add the strategic value to digital innovation. Can you shed some light? Can you provide some stories that for us to understand more intuitively?
Of course, I'm happy to. I think that we absolutely need to understand the customer context and the customer needs, because no financial tool will ever be adopted if it doesn't solve a pain point in some way. And we're often asked, but we are innovating for the future. Don't we have to understand primarily the future technology and the future infrastructure issues, rather than looking into what people are doing today, which might be totally different? And I think that what we actually can find here when we ask people, and particularly at this moment where digital transformation is moving so fast in the financial services industry, but also elsewhere, customers may sometimes be ahead of financial institutions. They may be able to work with avatars in their gaming industry and in their virtual environments, and they may actually be able to help us understand how digital tools of the future can be used to solve financial problems of today and of tomorrow for different persons. So it's very important to understand what's actually troubling people and what they're worrying about and what they're trying to do with their issues. And it's true that we go through a few examples, some old examples as well. And what we find is that Stones may come from seeing an innovation as a particular tool. We go back to a very old payments tool that was issued but didn't cover the whole ecosystem. So now you can't introduce a payment tool and only introduce it to consumers. It won't work if you can't use it with merchants. And maybe it won't work at all if you can't use it in the parking lot as well. So this is the kind of issues that you need to discuss. And I think that's very relevant for our current discussions with governments and central banks about how to introduce CBDCs. You mentioned the digital euro, but there are most of the countries across the world are discussing and researching on how to introduce new money and whether to introduce them as offline and online, whether to use them to build a completely different financial intermediation infrastructure on trusted infrastructures and allowing perhaps other organizations than just the traditional banks to be part of financial intermediation. So there are very big questions at stake. And to answer these questions, it's absolutely key to talk to people and to understand the pain points that they experiences and what they're looking for. For instance, here, I think that trust is a very major issue. If people are not used to trusting I think we studied, we mentioned the example of the e-Naira, which is one of the very few CBDCs that have actually been introduced in the world up to now. And one of the issues about the uptake here was lack of trust in government due to all the examples of corruption and poor money management, as we understood it from the qualitative studies. And that is absolutely key. If you do not trust the issuer, you're not likely to use the money that they issue. So I think that is a good example.
Trust is at core of most of the elements that generate value relationships in financial services. Now, towards the end of this episode, I have a key question that relates back to the title itself of your book, that is Customer-Centric Innovation in Finance. One of the issues I often see in the attempt to transform financial services by bankers and fintech is that they believe, or they tend to see personalization as an opportunity through data to charge, to load the bazooka for marketing that shoots something to a client, forgetting that in reality, as we said before, mobile is a technology of the demand, financial services is roughly oriented, and there's more to be done in order to make sure that people can engage transparently on financial services offered to make conscious decisions. So I don't think that customer centricity has always been understood properly. Now, how do you believe, and you reveal in your literature, that banks and fintech can build a real customer-centric organization? Erin.
I actually think that to a certain degree, being customer-centric requires also being research-centric. So you need to make sure you have a strong research strategy, you prioritize research, and you don't leave it as an add-on at the end of a design process. One problem we often see is that companies will invent this amazing thing, they'll go through the whole design process, and then it'll be nearly ready to launch. They'll be like, oh, we forgot to ask any customers what they think of it, or they'd realized they'd asked some, but they hadn't done extensive enough research. So companies would do well to consider research at the beginning of the design process rather than at the end. Companies can also think more broadly about what research is. You don't have to be that specific about, using the scientific method. It can be broader than that. They can be aware that there are often many people in the organization who have very valuable customer knowledge. So anyone working in customer support, sales, and so on often know a huge amount already about what customers are up to. That can also be leveraged. So I would say have a centralized research strategy for your company if you can, if that works with your departments. Make sure you know who in your company from different departments is relevant to the research process, and make sure you have an integrated process to get that research done and make the results known within your company as well, because sometimes research is done in one little corner and the rest of the company don't know about it, and then you can't encourage more insights to be coming into research. So that's important.
that resonates with me extremely well. And because the reason why we have this conversation is because the Banker's Bookshelf is dedicated to book authors and researchers that challenge the common status quo. Now, why does it really matter? It matters because, to answer Alan Greenspan's concern that we mentioned earlier on about the flaw in the model, we need to change our understanding of how things work. So we need to change theory. It's like we want to stop producing electricity with a carbon plant, and now we want to use a nuclear plant or something else. We need to change the theory before doing that. Otherwise, will not be good. So we need to research on the new foundations of financial services intermediation in order to be able to move forward. In my attempts, I looked at the anthropological perspective, the gap between Homo sapiens and Homo economicus in my financial market transparency theory. And I see that in your book, Customer-Centric Innovation in Finance, you're also looking at the anthropological perspective to redefine the sense, the scope, and the means of our action to change financial services. Now, let's conclude with a really key question. And I want to address this question to both of you. Synthetically, what does it mean to create a financial world fit for the Homo sapiens? And what is the way forward?
So on a very pragmatic note, I think that we would like to see far more financial companies doing what Erin just described, because that is probably a way to a good way to start, to take the first step. And then we also need to see that it may not be so that all financial institutions can cater to all people at all levels, but we need to be able to meet the needs of different people and different groups of people around the world, and to provide reasonably good access. And I think we need an understanding generally in financial services that if a product does not work for people or they find it difficulty, it's probably not the people that are wrong, but rather the product that's wrong. So we actually need to build things that can work in the everyday life of people wherever they are, whether that is overcoming technological glitches, or whether that is overcoming the fact that you need more people to work with an account, or to create over different transfers. So I think that we need to do this both at a financial services level, but also at a society level. And we need to think about designing for people.
It's an ecosystem changing perspective, if you like, right? Everyone needs to learn how to move forward with a different point of view. Erin, what is your thinking about that?
Well, I would say that we should keep in mind that 99% of the time, finance has nothing to do with money. And that's to say it has nothing to do with numbers. When people are doing their financial transactions, saving, investing, whatever, for most people, the end goal is not to amass as much money as possible. And that's the end of the story. People want to do stuff with that money. They want to fulfill their goals. They want to have social relationships and so on and so forth. And that is key to understanding how finance is human.
I like this. Finance is only 1% of the financial problem of people. So we need to learn how to move beyond that. So Anette,
if I might add, I think that you put it nicely, Paulo, earlier in this discussion when you mentioned that financial providers should think about actually providing something that people can control, but not necessarily expect that people want to control everything like a banker, because people in everyday lives have other issues on their minds than thinking like a banker.
Is always a balance in medias stat virtus. Anette and Erin, I thank you for this inspiring conversation. Everyone can find your new book, Customer-Centric Innovation in Finance, on Amazon. It has just been published, so possibly one of the very early conversations you are having out there when the book is out. And I invite all the people in the audience of Breaking Banks and the Banks Bookshelf to stay tuned, because the fourth episode, the next one, will feature none else than the Economist Research Unit to discuss their studies on financial impact. I remind you all that the Banker's Bookshelf is our collective moment of critical thinking, inspired by authors and researchers of the most interesting books, papers, and publications, which are finding their space in the libraries of curious bankers and fintech entrepreneurs. Enjoy the Banker's Bookshelf jingle. Arrivederci.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with Fintech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.